Zach and Ryan, good morning.
Hey,
Morning,
George.
guys.
Morning, Zach.
Happy New Year to you both, and Happy New Year to all of our clients. 2024 just wrapped up. We're filming this in January, but I'm guessing by the time that it comes out, it'll probably be around February or so. And so I know we're going to cover a lot of different topics today, but I thought I would just kick it off to start. I think one thing that comes up with investors is when they hit the new year, some people, New Year's resolutions, they're supercharged to, all right, I'm going to really sit down and tackle some of my financial decisions this year. But then they sit down with a pad of paper and they say, okay, where do I start? And there's a variety of different things you could be covering. It's hard to know sometimes what you should be prioritizing right out of the gate when you hit January and what things can wait till later in the year. So from a financial planning aspect, I thought what I would start covering is what I think are maybe 5 important general topics with some more specifics inside of them on things people may want to just consider tackling this year. And these are items that you don't necessarily have to do every single year, but maybe you tackle some of them annually, some of them you take a look at every couple of years. But yeah, I think out of the 12 wealth pillars on the wealth bridge that we talk about, there's 5 main ones that you want to keep top of mind each and every year when you hit January. And so I think from an investment perspective, and we'll look at this from 2 different angles, one for retirees and then one for people that are building wealth. But I think for retirees, when it comes to their investments, one thing that's good to think about when you hit January is, particularly after a year like 2023 and 2024, is from an investment standpoint, should I be rebalancing? Should I be taking some gains off of the table? And I think what goes along with that is, what are my cash needs going to be for the coming year? And that may come in the form of, a required minimum distribution that you have to take out, even if you don't need the money, or it may just be money from your taxable accounts that you need to sustain your living expenses over the course of the year. The reason why I think it's important to take a look at that in January is 2022 was a really good example. A lot of people, particularly on their RMDs, will think, well, I could do it in January, but maybe I want to stay invested for most of the year and then take out the RMD. 2022 was a difficult year to do that because the market dropped significantly in the first month and basically stayed there for most of the year. And so in that case, for people that were a little low on cash, they found themselves having to sell investments when the valuations were lower than they would have liked. Had they taken care of that in January, they could have maybe taken the cash out of their IRA, funded it for living expenses, and sold at higher prices. Now that's, one specific year. There's no guarantee that that's ever going to happen. But I think particularly when you have a couple of good years in the markets, you may want to think about that. One thing that makes people hesitate, particularly if they have big taxable accounts, is, hey, I don't want to be rebalancing and triggering gains. Again, it may be good to look at your retirement accounts, IRA, 401k, and say, hey, I can rebalance here, maybe get more conservative inside of those accounts where I'm not going to be triggering taxes. Even if I've got bigger stock exposure in some of my non-qualified accounts, my taxable accounts, I can take care of the rebalancing in some of my qualified accounts to get myself better balanced at the start of the year. So I think that's a good thing to think about for retirees. For people that are younger, maybe building wealth, people that are contributing to different investment accounts or savings accounts as the year goes on, I think it's important to think about taking care of that early on in the year. And there's a couple of different buckets you might want to think about funding early on in the year. I think most notably, something I do for myself every single year, I've got a rainy day fund where I try to keep 6 months worth of expenses. It's just set off to the side, hopefully never going to have to use it. But, something you read about in the news over the last couple of years is inflation is higher than people liked. And so even though I hit my 6-month goal a couple of years ago, it probably cost more to buy things than it did a couple of years ago. And so each year it's good to take a look in January and say, hey, maybe I want to throw an extra, X amount of dollars, couple $100, couple $1,000 into my emergency fund, just to add to that, to account for the higher cost of things that are out there now. Another thing that's important is for people that have IRAs or Roth IRAs, taking care of those contributions early on in the year. And so one thing I think people talk about a lot is, hey, if you can start contributing to those accounts at 25 versus 35, you're going to be a lot better off, when you end up retiring and start living on those funds. But I think something that people talk about less often is, well, what if I contribute earlier in the year versus later on in the year? And so what I'm showing here is just from a blog I wrote a couple years back that just really goes along with the same principle of starting to contribute in your 20s versus your 30s. But, markets are up more often than they're down year by year over the long term. And so these two charts basically just break out, okay, if I start contributing in January of every single year and I do that for 30 years versus waiting till December of every year to do that, it builds up over time in terms of compounded returns. I don't know if you can see these numbers, but basically what you'd end up with, putting, I think when I wrote this, the max IRA contribution was $5,500 for 30 years at a 7% rate of return. If you did that in December of every year, you'd have around 520 grand. But if you did it in January, you'd have around 555,000. So over 30 years, a $35,000 difference, it's not huge, but I think it just brings home the point that similar to starting contributions early in terms of age, it still holds true for starting early in terms of the time of the year. And I think that holds true for your 401k, 529 accounts, HSA accounts. And so I think those from an investment perspective are two things that are important to think about in terms of how much am I putting away into my investment accounts or my savings accounts? Should I be upping that for the year? And can I afford to do that earlier on in the year? And I think it's going to put you in a much better position when you go to retire than if you were to, wait later on in the year, each and every year. I think something else that's important, the second area is taxes. People are getting ready to file their taxes in April. It's important to be looking at, your tax return from last year and talking with your accountant about what are some things that I can do this year that might allow me to lower my tax bill. One example might be if you're somebody who used to be a W-2 income employee, Zach, I think you have a client that this just came up for, who now has 1099 income. She's got the ability to put money into a SEP IRA, which is potentially going to substantially lower her tax bill, while allowing her to put more money away for retirement. And so it's important to take a look at how your circumstances have changed from a tax perspective each year and seeing how you can, change things in order to lower your tax bill, not only in this year, but in future tax years. Whenever you can use tech to help inform those decisions, I think it's really important. We've started using new software called the Holistiplan, and I think Zach, you had a case with a client recently who was doing Roth conversions every year, and by reviewing his tax return, I think he was using TurboTax, had realized that he wasn't accounting for that income each and every year. Similarly, I had a client who was given to charities. I wasn't aware of it, but going through that process of looking through their tax return, we were able to see, hey, you should take your IRA distributions and give to charity directly from your IRA. And so, it wasn't something maybe we were able to do as much in the past, but now that tech has evolved and we're able to better inform our decisions through tech, I think engaging with, advisors like us on your tax situation before April comes can be really important. Third thing, we've talked about this before on previous podcasts, is just looking at your beneficiaries on your investment accounts or looking at your current estate plan. If you got a trust in place, the tax laws might be changing at the end of 2025. It seems unlikely that that's going to occur now that the election results have come to fruition, but it's important to be talking with your attorney about, hey, what's the likelihood that those things are going to sunset, and do I need to be making any changes to my estate plan? I think a fourth thing that's much more prevalent today than it's been the last 5 years, and it's a bigger deal now than it's ever been, is cybersecurity. It wasn't as much of an issue pre-2020, and now you're reading stories every day about people getting their information stolen or used to set up new bank accounts or new credit limits, and it can be a very scary experience to go through. And so I think when you hit January, it's important to be asking yourself, hey, when's the last time I've updated my passwords? Do I have diversity amongst my usernames and passwords? Am I using the same password for everything? Do I have any sort of multi-factor authentication in place where I'm getting a text every time, I have to log into one of my bank portal or my investment portal? Do I have any sort of identity theft protection? Do I use LifeLock or Privacy Guard? So if somebody does get my information, I can help protect against that. I think when you hit the new year, it's a good time to reset and say, hey, this isn't something I had to deal with 10 years ago, but we always got to evolve our planning as the years go on, and this is a new and important thing we need to be considering. And so I think those are all really important things to keep in mind when it comes to cybersecurity. And the last thing I'll say is surrounding insurance. If you have insurance, people tend to set it and forget it. But insurance can be used in a variety of different ways as the years go on. If you're somebody who was newly married or newly had a child, maybe you never had insurance before, maybe you need to add it. Maybe you're somebody who had some sort of insurance in place to protect against loss of life, but now you're retired, you don't need it as much. You might have an opportunity to change the type of insurance you have, drop a certain amount of coverage to save you cost, convert insurance into an annuity type product, investment type product. So those are all those 5 areas, investment planning, taxes, insurance, cybersecurity, and estate planning. I think when you hit the new year, it's important to be looking at those, even if it's just briefly. And I think something like contributing to your investment accounts every year, your retirement accounts, that should be an annual process. And some of the other things, maybe you do it every other year or every 3 years or 4 years. But just having that checklist in place and to be able to glance at it every year, I think is a really good starting point. And that way you can move forward, as you go on throughout 2025 and say, hey, there's nothing glaring that I need to get to right away. I can kind of hit the pause button and then, address some of the smaller items as we hit the summer and the fall and the winter. So that's it in a nutshell. So I don't know if there's any questions on any of that, but if not, Zach, I can just turn it over to you. But those are my 5.
Yeah, thanks, George. I think that was really good. And one thing on the timing of the IRA contributions in your example, I thought that was really interesting of just, do it in January versus December. And I think one thing people try to do is kind of time the market with your contributions of saying, oh, using the S&P 500, which is the U.S. like large cap index, that's at an all-time high. Should I, wait a little bit and, maybe it'll dip and I'll be able to buy in at a little lower price. And, people who maybe last January, the S&P 500 was at an all-time high, and they said, oh, I'm going to, wait for it to take a dip. And, 2024, the S&P 500 hit 57 new all-time highs, and you were kind of just always waiting for that dip. So over a longer, time period, your example was 30 years, odds are it's going to go up in the year. So it makes more sense just to do it in January and kind of be done with it for the year. And there's going to be years where, it probably takes a dip, after the point, and, it'll be, a tough pill to swallow, but more often than not, that's the right time to do it.
Yeah, I think if you're truly not going to need the money for living expenses or a big trip, or you're buying a new home or new car or whatever for the next, 3 to 5 years, I can hear the argument for, hey, let's keep it invested as long as possible, each and every year, because like I said, markets more often are up than they're down over the long term. So I think it can be beneficial to wait. But I think for anyone that says, well, I may not need it this year, but I'll need it next year, should we wait till December? There's too much of a question mark there of what's going to happen with the market. And I think what people can do now is take care of it, have that peace of mind. Listen, I've got my cash, I've taken care of my RMD for the year in January, and you can park it in a high yield savings account, which is a lot more attractive than it was 5 years ago. So even if you can only get 4% and the market's up 6 or 7, the certainty of knowing I've got my spending for 2026, I was able to get that loosened up and ready, and take gain off the table and rebalance in early 2025, and I was able to get a decent chunk of interest in a conservative account. I think that's a really good trade-off. You can give yourself peace of mind that that's not a bad decision in most circumstances.
Yeah, for sure. No, I think those are great points. And the thing the topic I wanted to talk about was like global investing. So we always, I would just reference the S&P 500 as being the large cap US index, and that really is just a small piece of global investing. I'll share my screen here and show one of my favorite charts when it comes to thinking about investing. So here we have the world market capitalization, and this is as of December 31st, 2023. and it shows the weights of each country's market cap as you think about the whole world. So you can see on the left here in the blue is the US, which makes up 61% of the world market cap, which is a huge portion of it. And you can see on here, I think it's really cool how it shows there's about 3,400 companies in the US, and in total that market cap is 50 trillion. And then the yellow is what we consider developed ex-US. So Canada, United Kingdom, Germany, France, Japan is in there, Australia. Each one of these are substantially smaller than the US is 61%. In fact, in the US, Apple makes up a little bit more than 4% of the world's market cap. So bigger than France or Switzerland or Germany or Canada. Japan is really the only country that's bigger than Apple market cap wise. And all these different sizes change from year to year. As I mentioned, this is as of December 31st of 2023, and I'll flip here and we could talk about what happened in 2024. This is a chart that I know Will in the past showed on this podcast, but this is the updated version as of December 31st, 2024. So all the way to the right here, we can see the different asset class returns for the year. So, 2024 US large cap. So that S&P 500 led the way at 25%. So fantastic year on the back of a really good one in 2023. US small caps did really, really well. As we're kind of focusing on equity investing here, I'll go emerging markets. So those are your China, more Brazil, Argentina, countries like that, averaged about 8.1%. And then down here at the bottom are the developed ex-US at 4.3. So I want to kind of show, this is one extra year where the percent of the world market cap is at now after another additional year. I'm going to switch slides here. And this chart has a lot going on, but what I want to focus on right now is this top right-hand corner, which shows percent of, US or percent of country market cap in the world. So this gray bar represents US. So, as of 2023, it was 61%. Now it's grown to be 67% of the world. And, it's funny how much these have changed over the time. And I've got some stats here showing, what the US has done compared to Japan, really since 1990. So in 1990, the US made up 32% of the world, and Japan made up 41%. And you fast forward to 2000, as we were building up to what ended up being the tech bubble, we didn't know it at the time. The US grew to be 52% in 2000, so right here, and Japan fell to 12%. So that was a huge turning point. But then you'll notice here during this period from 2000 to 2010, the US lost. It fell from 52 to 44. So that's during the Great Financial Crisis. This is a period that, in terms of U.S. investing, is known as the lost decade, where the S&P 500 lost money. And then really since then, the U.S. has just continued to grow and grow and grow. And I'm not trying to suggest that, the U.S. is going to, fall to 10%. The U.S. has some of the, largest, best companies in the world, and it's going to continue to do great. But I think we want to just be diversified. If the 67% fell to 60%, that would, really hurt if you were, heavily overweight US, if you were 100% in US equities. So I think we want to be diversified, in markets where the US maybe doesn't do as well as Japan or, Europe or emerging markets. We want to, own the whole world. And another interesting point here that I thought was, or another point that I thought was interesting was 2024. You could see here what the different countries did. So I mentioned, US was up 25%. But really, as we think about international investing, there's what's considered local currency and then US currency. So in terms of local currency, Japan returned 21%. But, I live in Chicago, Illinois. I don't exactly care what Japan's stock market did in Japan's dollar. I want to convert it to USD. And because the dollar has done really, really well and did in 2024, for me owning a Japanese equity, I would have only returned, 8.7%. So that is another headwind towards international investing is the dollar strength. And if the dollar were to fall and Japan equities do well, I kind of get a double whammy. So I think that there's a lot of things that go into it, but we want to just make sure we're owning the whole world, because there's great companies in the U.S. As well as international. And another one last chart here. This just shows out of the top 50 stocks in the world, U.S. or international, doesn't matter, which piece or how many of them are in the U.S. versus how many are not in the U.S. So this green bar shows, how many are in the U.S. And I was kind of surprised with how many were not in the U.S. So over the last 13 years, about 37 of the top 50 companies on average are based not in the U.S. And I think that that's really kind of a compelling story. I want to make sure I own those in, a diversified portfolio, so I can get some, good, or get a piece of those returns, even if it's just a small percentage of it. But yeah, so I think that's the case for being internationally diversified. And I was thinking also, people say, I don't want to own anything outside of the U.S. There's no good companies there. And one that really comes to mind is, automotive manufacturing companies. And I know Ryan and George and myself all own not U.S. cars that we drive to work every day. I just thought that was kind of a funny story, a funny component of it, because there's great companies all around the world. We want to make sure we own all of them.
Yeah, no, these charts are great, Zach. And I feel like we have been talking about this a fair amount on the podcast, and I feel like it's important because diversification, I think, has come under fire a little bit. I don't know how you feel, Ryan. You've been doing this longer than us, almost maybe more so now than ever, because the U.S. stock market, which is what people see in the news, has done better than pretty much everything. It seems like year over year, the last 6 or 7 years, even better than U.S. fixed income, U.S. small caps, it's basically the S&P 500, which is a fair representation of the total market, but has a lot of large cap companies in it. That specific sector continues to outperform. But one thing that came to mind when you were talking about Japan's a really good example. And again, Ryan, I might need to rely on you for this in terms of the numbers. But when I think of the U.S. and Japan, it's almost like when you think about a mutual fund that has a lot of different companies inside of it and concentration risk, countries are no different. The U.S. is just one country out of many. Now, the U.S. for all of our clients and most clients in the U.S. makes up a significant portion of their portfolio, because there's always usually some sort of domestic bias that kind of goes along with where you live and how you invest. But I think Japan's a great example of the dangers of putting all of your money into a single country, because I think that's the question that comes up when people are arguing against diversification is, why don't I have all of my money in U.S. large cap stocks? Is because I think Japan, when that stock market cratered, it took, was it 29 or 30 years to get back to the levels they were at, Ryan? Does that sound right to you?
Yeah,
I think it was sometime around COVID, it finally had got back to the break-even point. And so we talk about the lost decade with the U.S., but that was basically a third of the period that the Japan stock market went through. So for, if I just parallel what we're talking about here to, if our clients live in Japan, we manage money in Japan, and we took the same approach we did with clients, that would be an extremely tough period to live through. And, it's easy to brush that off and say that won't happen again, but it did happen. And so I just think it's important to keep that in mind. And when you think about why do you continue to diversify, it's just because those types of situations do come up. It's not to say that it will happen in the U.S., but it happened to Japan. So there's no reason why it couldn't happen to the U.S. So sorry, Ryan, I cut you off.
Oh, you're good. So Zach, I mean, you brought up a good point using the car industry, right? So if we have domestic vehicles, that's kind of a microcosm of, the market conversation, right? The components of that vehicle, how many of those are truly made in the U.S.? You pick up the hood of an engine and look at the components of the car. I would best guess that most of those components are built in other countries, even though they may be assembled here. That just goes to show you the multinational aspect of how much things have grown globally throughout the last 20 and 30 years. I may, if I may, introduce myself to the new podcast recording. I have been in as a financial advisor for over 20 years. This is my 14th year at McCabe and Associates. this is my very first podcast. So George, you talked about tech and how far that has come, and look what we can do in our offices just by a click of a button. So, tech has definitely come a long way. We brought up some very valid points as far as, financial planning aspects, the way to look at markets, the way that we as a firm and our philosophies look to invest our clients' money. The one topic that I kind of want to touch on today, and what I have been seeing recently, not recently, but I would say over the last couple of years, is the distribution planning. I believe that is the art of what our firm specializes in when it comes time for the topic of retirement. And it's a difficult way to think about, hey, I've been geared to work 30 and 40 years as an employee. I've been saving and putting my money away in various vehicles and IRAs or Roths or my 401ks. What is the psychological effect from saving now versus spending? And that is a conversation that I've been having a lot with clients who have retired in the last couple of years. And it is something and that does take a lot of planning to go through, because what you're doing is you're gearing yourself up for working and putting kids through school and saving and paying down debt, and now all that stuff is done and it's time to enjoy retirement. So what I was going to talk about is the psychological saving versus spending aspect, how to spend in retirement, right? Kind of phasing into retirement, where there's been conversations, hey, do we have a hard stop? Meaning I am retiring on June 10th, 2045, which is my birthday, by the way. And June 10th of 2045, I'll be 67 years old. Hard to think that is coming, but it is. Do I have a hard stop? Do I phase into my retirement? Meaning, do I work for a few days a week and finish out a year or two? The hurdles that we talk about, I talk about this with a lot of my clients when we meet, the age hurdles, and I can run through them really quick. 59 and a half is kind of the earliest when you can look to take money out of qualified accounts, IRAs, 401ks. Certain 401ks will allow earlier without penalty. The 10% penalty pre 59 and a half rules that apply to that when you can take money out of qualified plans. Age 62 is the earliest that you can now collect Social Security, but that is a early collection, and there are some what I like to call handcuffs on age 62 collection of Social Security. There is an income limit on what you can make if you decide to continue to work and collect Social Security at an early age. Age 65 is Medicare, and I went through that exercise with my parents. And most recently with my mom on renewing her Medicare. Obviously Part A is covered, but the Part B supplemental aspect of it, and to go shopping for a solid supplemental Part B, what does that look like? Do you go from a private standpoint? Do you stay with Medicare, and do you add the various plans that go along with that? And then obviously prescription drug programs, which there's a slew of those. That's your age 65. Usually age 67 in some months possibly is when you can collect your full retirement Social Security number. We refer to that as FRA age, your full retirement age. That allows you to collect your full benefit by taking the income handcuffs off for Social Security. 70 is the longest you can wait to collect Social Security. 73 is your required minimum distribution age as it sets right now, where Uncle Sam will require you to take out a certain percentage of your IRA or your qualified funds based on your age and life expectancy tables that the IRS publishes. So from 59 and a half till 73 currently, there's a lot of things to consider when it comes time for retirement, for distribution planning, for all that stuff. So recently I've been working with clients on the age 60 to 70 category, right? Hey, you know what, we're retiring. we're going to travel a lot more. We're going to use a lot more money up front, based on what we have saved throughout our years, and based on the balance sheet that we have. We were thankful to pay debt down and basically have very little to no debt. What is a safe distribution rate that I can withdraw from my money that I have saved throughout these years to make sure that that money lasts. The biggest question is, I always tell clients this: you tell me the age of which you're going to pass, and I'll come up with a perfect financial plan for you. But nobody knows that, right? Nobody knows that number. So we have to prepare, and we have, George, you mentioned the technology. We have technology out there that we can provide certain ratios on how long money will last. Through Money Guy Pro is a program that we use that will show certain distributions throughout a certain time. We usually look at age 90, 95 for clients, both married, to make sure that we leave a buffer for distribution. But more or less, you're going to spend more money from retirement up in call it the front years of the age 60 to 70, right? Age 80s to 90s, there's kind of a lull. You're not going to be traveling that much. Maybe you take a backseat of traveling and do other things, or slow down a little bit. Maybe you don't need that much money that you had to distribute in your early 60s and 70s. That now you're in your 80s and 90s, that you're just, instead of traveling twice a year, maybe it's once every couple years. And then obviously in the age 90s is something that, we got to prepare, for possible medical type expenses, where other things can come into play from that. So there used to be an old rule out there called the 4% rule. I'm sure everybody that is listening to this is somewhat familiar with that, where, if you were to withdraw 4% of your retirement savings, that was sort of a safe withdrawal rate. But again, that's a guideline. It's all based on, the market performances throughout the years. Zach, you showed, a chart of as far as what the U.S. has done throughout the years. Every year since 2000, I have recorded all three indices of the S&P 500, the Dow, and the NASDAQ, of what their closing numbers were at December 31st. It's just kind of a hobby that I had. I always wanted to track and see what the markets, where they've come from versus where they are today. And I was just recently showing my wife on a spreadsheet, and what I do is I color code them. I color code the indices. If they're green, that's a positive year. If they're red, it's a negative year. And I told my wife, I said, "How do you see more green, or do you see more red? From 2000 up until 2024." And by far, it's mostly green, right? I mean, we do have those, call them the hiccup years. They're not fun to live through. I've guided clients through those years, through the financial crisis of 07, 08, 09. We had some setback years in 2014 and 2015. The COVID years. There's a lot of uncertainty when it comes time to discuss the retirement aspects. But I think one of the strong suits that we have at the firm is, number one, not putting all of our clients' eggs in one basket, right? That's really the definition of diversification. My grandfather kept it simple when I was growing up. Hey kid, don't put all your eggs in one basket. Spread your money around. And that's what we stress to our clients today. That's how we invest our clients' money from a fiduciary standpoint, and providing them as much guidance as we can to make sure that they are touching all those different asset classes, Zach, that you illustrated, right? So when it comes time for retirement in that distribution phase, that if the market does have a pullback, or if there is certain circumstances that just the market is not accounting for, we stick to a disciplined distribution plan, and we make sure that that plan is in place regardless of what market conditions are. We adjust on the fly when we have to, and that is an art. That is an art that I think a lot of I would hope that most financial firms practice. I know that is our core stone here. The art of making sure our clients have the necessary funds to get them through retirement, And, through the 14 years here at McCabe and Associates that I've been here, and I'm sure, the predecessors before me got to see on how that plan of fruition comes into play. I have clients who have been retired now for 10 years, and they're still in very solid financial condition, even though they are, withdrawing their funds. It's a discipline, but it is something that is also psychological, that, we talk with our clients about when it comes time for retirement, and the importance of staying to a disciplined retirement distribution strategy. So that's kind of what I wanted to talk about, from relative terms of what I'm seeing today, and the planning aspect of clients that are approaching the retirement years. I would say it's vitally important, within a year or two out before you're thinking of retirement, to kind of go through, hey, what are the phases? What are the ages that I need to be aware of? What are the simulations showing from a distribution strategy? Here's what I've saved. What does my balance sheet look like? Have I paid debt down? What are the goals that I want to achieve in my retirement years? I want to take my family on multiple trips. I want to take them to Europe. I want to take them to Disney. I want to take them to Hawaii. Those are things that, we can take a look and account for. But it is vitally important to have those conversations once you start thinking about those retirement years. Last I want to touch on is when you do retire, the biggest thing that I've seen is what are your hobbies? What do you enjoy to do? Like I said, all of us today, Zach and George and myself, and I know I'm filling in for Will today. For those that don't know, in our firm, Will and his wife Abby welcomed their first child. So just want to congratulate, the family on the birth of their new daughter. But what the thing that I wanted to focus with and talk about was, what are the things that you want to do in retirement? Because those are the important things. When you retire, the first 3 weeks are cool. Hey, I don't have to get up. I don't have to get dressed. I don't have to fight traffic to go into work. I can enjoy my cup of coffee. But after, I think, 3 weeks, that might get old. What are your hobbies? What do you want to do? What are the things that you're passionate about? So those are the things that I know clients really reach out and talk about. And then we want to focus on that. So thanks for having me on my very first podcast, gentlemen. I appreciate it. And, that I think these are great public service messages that we can provide to our clients. And then those can raise conversations when we meet on our reviews.
No, we're happy to have you, Ryan. Thanks for covering that. I think that psychology piece of it is extremely interesting. And, the purpose of this podcast, number one, is just to educate, investors, whether they're clients or not. But, part of, there's a reason why we do this for a living. It's because you believe that having an advisor at your side, throughout your entire financial journey is worthwhile. But I do think that retirement planning aspect of it, if I had to say, hey, this is probably where you need an advisor more so than any other time in your life, is that 60 to 70 time period you were talking about. And I remember shadowing my dad at meetings early on when he would talk to clients getting ready to retire, just preparing them for, it's going to feel weird the first 3 months when you stop having a paycheck come into your bank account. For younger people, as they're planning, if they're not as on top of it, it doesn't stress them out as much, I think, because they know, hey, I'm still continuing to build wealth, even if I'm not being as tax efficient as I could be, or I'm not, perfectly investing right now and the returns aren't where I want them, or I haven't gotten insurance, because they continue to, get a paycheck every 2 weeks and they're able to meet their expenses. And they know that income stream is going to continue to come in, whether they perfectly plan or not. But it's different for retirees when they stop working and then they say, this pot of money is all that I have. And I think what goes along with that is you mentioned a lot of those really important planning topics that we'll talk about in the firm, Medicare, Social Security, RMDs, things like Roth conversions, doing a lot of those in your 60s. That's all packed into that 10-year period. And stuff like Social Security and particularly Medicare, are really complex animals. So some of the most important and difficult topics are jammed into this 10-year period, which is probably the most important financial period of your life. And I think if people were to ask me like, hey, if I only need an advisor for like 5 or 10 years, when would you say? I would say it would be during that period, because when you stop having income come in, I think it's nice to have someone next to you you can go to and say, is my spending okay? This is what we were thinking about, but now this is what we're actually doing. Are you tracking the investments? We had a tough year. Are we still going to be okay? I think it'd be really comforting, with whether it's an advisor, your spouse, or a trusted friend or whatever. But I think having an advisor, someone who's been doing this for a long time, who's been through hundreds of different retirement scenarios with clients, to say, you know what, we've seen this over the course of several decades, and this is how it's generally played out. But if it doesn't, here's how you can tweak your plan in order to cover what you need. And so that's, I think, it sounds really simple, but that's why that psychology piece is so important and specific to that time period, is just because that income flow cuts off. And so that's when you really need to focus on your planning. So I think you covered it extremely well. Zach, I don't know if you have any closing comments. I'll pass it over to you before we wrap up.
Yeah, I just think the different topics we talked about today, I feel like so many people will watch CNBC and want to talk about the newest semiconductor stock or AI or cryptocurrencies, and like that is it is an important part of like building a portfolio and understanding what's going on in the markets and different being allocated certain ways. But there's so many different parts that go into being having a sound financial footing, from the George, we were talking about cybersecurity to withdrawal planning to Social Security and Medicare and all that. Like it's a very complex, system of things that you have to kind of keep track of. So I fully agree with the 60 to 70 is a time to have an advisor to, help you through that whole process. But yeah, I think this is really helpful for a lot of different people, or will be.
Good. Well, Ryan, thanks for joining today. And Zach, as always, thanks for hopping on. So I appreciate you both being here, and hopefully it was helpful to everybody else for episode 3 of Building Your Wealth Bridge. So we will wrap up for today. Happy New Year again to everybody. For any clients that may have questions about some of the things that we covered today, feel free to reach out, give us a call and set a meeting. Happy to go over it with you. And for any prospective investors that want clarification on any of the topics that we covered, feel free to reach out to our firm. So thanks, Zach. Thanks, Ryan.
Thanks, everybody.
Thanks, guys. Take care.